You're about to join Jerry Parker, Moritz Siebert, and Niels Kostrup-Larsen on their raw and honest journey into the world of systematic investing and learn about the most dependable and consistent yet often overlooked investment strategy. Welcome to the Systematic Investor Podcast Series.
Jerry Parker, Moritz Siebert, and I, Niels Kostrup-Larsen, are back with this week's edition of the Systematic Investor Series, which is our weekly ongoing raw exploration of the world of rules-based investing, and of course, where we also take some of your questions. But today we're going to deviate a little bit from our usual format because we are delighted to be joined by a very special guest, namely Salem Abraham, a true trend-following legend, and of course also a good friend of ours. So let me start by welcoming you to the show, Salem, as well as saying good morning to you, Jerry, and good afternoon to you, Moritz.
Thank you very much. I'm glad to be here, Niels. Jerry and Moritz, it's fun to join you.
Good morning.
It is great to have you with us today, and we certainly look very much forward to diving into to sort of your world and all of the things you've learned from many decades of being a quote-unquote die-hard trend follower. But before we do so, Salem, normally we just do a little bit of a review of the past week, and maybe because it's month-end, quarter-end, half-year-end 2019, maybe we'll just comment a little bit on that as well. So if you have a cup of coffee ready, then you have a chance to take an extra sip or two while we just go through the highlights. Hope that's okay with you.
Sure.
Good stuff. Now, U.S. stocks had their strongest June, I'm told, since 1955, recorded their highest ever monthly close, leaving investors in the S&P 500 up 17% so far this year, marking the best first half in more than 2 decades. We saw continued fears for the economy, and that put a rocket on the government bonds yet again, with treasuries up about 5% or more for the first half. And the yield curve and all of that inverted. And the pool of negative yielding debt around the world has swelled to a new record. So even though the bonds are screaming recession, it seems like the stocks don't really want to hear that. And of course, over here in Europe, we have had a real heat hitting us in June. But trend followers continue to be on their own little hot streak as well, finishing a decent first half of 2019, at least if we look at the indices. So with all of that in mind, Moritz, how did June? How did Q2? How did
June go?
One?
Yeah.
How did half one go from your trend following perspective?
Yeah, 2 tails really. The first half, as you guys know, I was essentially after January going into a drawdown, and it took until June for that to be recovered. So I'm slightly ahead now, only a little bit, but better than being down. As far as June's concerned, June was good. The past week, I must say, was a bit difficult for me. I lost about 1.5%. Most of those losses coming from the currencies. Bonds good, emissions good. I lost on the energies. I got longer in gold. In fact, I must say, looking at the portfolio, I'm just looking at it right now, the way that's distributed between longs and shorts, I actually kind of like it. When I was looking at the same thing earlier this year, I had much more concentrated positions on the short side. Becomes more distributed now. Getting longer the equities. I'm still short some of the markets, but like you said, Niels, with the June as strong as it was, it's difficult to keep short positions on. So I like the way it's positioned, and looking forward to July.
Absolutely. I mean, it's for me, it's kind of nice to see that we've had a period of time now, 6 months, where we've had no crisis whatsoever. I mean, bonds are pretty strong, equities pretty strong, and trend following has been pretty good as well. So it's nice to see that this label crisis alpha doesn't really have to play in for us to do well, and I think that's something we need to continue to make as a case, so we don't get too bogged down every time people shout that why didn't you deliver any performance, because the S&P was down 5% last month. So anyways, from our point of view, June was good, pretty solid. At a bit more than 4%, I think, at the end of play, up a bit more than 16 for the year, so that's good as well. Not a lot of change position-wise. Like you, Moritz, the last week was difficult. That gave back a little bit of the early gains for the month, but still okay. Added a little bit of exposure to stocks in the last couple of weeks. Fixed income, certainly down from the highs in terms of exposure, but it's still where the performance is coming from, certainly in the first half this year. Other markets that's done well for us in the first half of the year, gold, a couple of the grains did okay, cotton did okay. One single equity market that did well was the Australian equities, and then in the currencies, really just the euro mainly. The rest was slightly negative, and the rest of the markets really, in terms of sectors, meats were difficult, energy was difficult, equities overall were a little bit difficult because of the U-turn we saw back in December or late December. So it took us a little while to get back on track. But like you, Moritz, we've maintained a couple of shorts in the equity still, predominantly in the Far East. So yeah, I mean, all in all, satisfying start to the year. And yeah, we'll see how the second half pans out. But of course, Jerry, we're always excited, not only I should say now because you trade single stocks, but now you also trade Bitcoin, and that certainly had a couple of interesting days this week.
Yes, I'm happy to be trading Bitcoin. It's a pretty small position, but crazy move up, and it was amazing. I was laughing about how crazy it was, and I had a $900 profit like the next day, and then it just started going up 1,000 and 2,000 and 3,000. Then it was crazy on the downside. Thursday, tried to recover a little bit on Friday, and then I think it's down a little bit over the weekend as well. So I'm really preoccupied with the smallest position in my entire portfolio, which is not a good thing but in a good way. I think it's just kind of funny. And I do think that there was a couple lessons. One is, trade it small, let's say, but also this is a big lesson for most people who kind of realize that, being up 30%, 40%, 50%, it doesn't really mean anything. It's probably safer to size these markets based upon their average true range and something like that. So I know you've mentioned hogs before that has these gigantic percentage moves, but it was, 2.5 ATRs. And I think sort of similar with Bitcoin, the ATR, it does keep getting larger and larger. I think when I first put it on, it was 500, or now I think it's up to 1,500. So that's a little issue with looking at things in terms of ATR. The ATR can get really large and not be very similar to your ATR when you entered the market. But also holding on to something like this that, it's kind of a pain in the ass that it skyrockets in a vertical way, and then it goes down even faster than it went up, and you just got to rely upon your anchor. You have this entry price with some built-in profits, not as much as it was, but don't try to get out of this trade with this short-term profit. You just got to hang in there and wait for your exit, really, at this point. But you just kind of, I did have this tweet where I said something like, well, people were talking about Bitcoin and like, oh, this time it has value. And I was like, what are you talking about? Nobody doesn't have value this time. How do you define this value? And I got to thinking it's Bitcoin. You sort of have an advantage when you trade Bitcoin versus other markets. It would just be better for all of us if we realize we didn't know anything about any of these markets the way we realize we have no clue about Bitcoin. Just follow the trend and follow your system. What do you think, Salem?
Oh, no, I agree with that. I don't trade. I'm here grinning because Bitcoin, I have not traded it, but I don't think Bitcoin, as utility. So I'm from the country where, you look at things like an acre of land, a cow, things like that have value, have utility. And, any currency today is a fiat. It's a fiat currency, which means it's backed only by, it's backed by nothing. So given that the U.S. dollar's off of we've been off the gold standard since the early 70s, the the U.S. dollar has no real value other than the perceived value that people give it. And the Bitcoin is the same way, sadly. So I'm the type of guy that I'm like, I don't like really any currencies, including Bitcoin for myself, but you got to trade them, and you want to trade them and you've got to use them. And so I think at the end of the day, you've got to use what people, whatever they ascribe value to, and you've got to be trading it. And then why things go up and down, that's the human emotion about it. And so there's really no logic for any of the currencies that are fiat currencies in the world, which all of them are, to have value. So, and really there's not reason for gold to have value other than people have always thought it was valuable. I heard a funny thing about gold, which made more sense that gold had value. It said, well, girls like shiny things and guys like girls throughout time. Therefore, gold has value to men and women. And I thought, well, now that makes sense.
That makes perfect sense.
So anyhow, I guess that's true of everything else. So it comes back to that. But yeah, no, to follow markets, even though they don't make sense, is at the heart of what we do as trend followers or quantitative traders, where you just follow the math. So yeah.
I mean, negative interest rates don't make sense.
No,
and the world would be a much better place sometimes when, if, for instance, people in Venezuela had the Bitcoin app on their phone, they would not have lost so much of their wealth that the government kind of took from them by destroying the currency. So I do think to some degree, if we just can all, it is kind of seems a little tenuous that we're all basically what you're saying is we agree this thing has value. We agree now it has value, but of course we maybe would disagree later. But it is kind of a strange world where something like Bitcoin, we barely understand that it's sort of based upon whatever agreements or hope that sometimes it could be way more trustworthy than a sovereign government's currency.
Right. Well, when they're printing, I don't think we can trust a sovereign country's currency any more or less than Bitcoin. But because there's people, and maybe you trust Bitcoin more because there isn't a sovereign government doing what they're doing. But I mean the negative. I think you bring up a great point. Negative interest rates. Never in recorded history, going back to writings on the sides of caves, have there been negative interest rates. I mean, I think we lose sight of how bizarre that is to have negative interest rates. But it's a manipulated market by central governments, and the only way it gets negative is when you have central banks. Yeah, central banks making it negative. So, it's bizarre. And then to follow that market there is, if there's one for me that's hard to do, that's hard to do. So, yeah, to go long negative interest rates, betting they go more negative.
I think there has been a negative commodity. I think I heard about that a long time ago where you had to pay someone to take it off your hands.
I wonder what that would have been.
Yeah, I don't know.
Yeah, no, but you could see that at some point if it becomes kind of, like, let's say we go completely to renewables and then crude oil gets to be something that you say, no, we've got this crude oil sitting there. It's just waste. We've got to go get rid of somewhere.
Oh, wow. That's going to make you popular in Texas.
Yeah. Well, they haul off salt water. Salt water is a byproduct sometimes of a crude oil well, and you pay people to haul that off. So, and then they go dispose of it in a saltwater disposal well. So it would be like that, I guess. So,
Well, that's the whole key to trend following, and kind of what we bring to the table a lot of times is we're the only ones dumb enough to stay long bonds or stay long stocks when the whole world is like they're overvalued. This trend is not going to last, and even hear some trend followers badmouth stock trends because of the old crisis alpha formula and stuff that we need to have a bad stock market so people will like us. But it is one thing we do bring to the table, unlikely, unusual things. We just stick with it until the trend reverses. So
it's kind of funny that in a world that's become, just from listening to your conversation here the last 5 minutes, you're bringing up points that, really most people would think, well, that's an incredibly extreme world we live in. And to me, that makes it even more interesting and harder to understand why there is still such a big part of the investor community that don't like what we do and needs to have, a reason and an understanding for the things that they invest in, and would rather believe someone who sits in front of them and say that they know what's going to happen. Yet, almost every day we see surprising things happening. But I want to take a step back, Salem, because I know we jumped straight into a conversation. But I want to take a step back, if I may, and just to frame our conversation today. Of course, we all know you well, and we know you've been around for a very long time and have a very distinguished career in the trend following space. But some of our listeners may not be as familiar with you as we are. So perhaps you can give us a bit of background. But unlike, the usual standardized bio that everyone can look up on your website, maybe share some of the things that is not on your official bio that you think has really been important and impactful in your career, and maybe why you ended up doing what you do now.
Sure. Yeah. No. I grew up in Canadian Texas, little town in Texas, but really a math kid. I'm good at one thing. And that's math. And was interested in investing in business, and my family is kind of full of different entrepreneurs. So business and math, that's what I was interested in. And so I went to Notre Dame to major in finance. And when I was about 2/3 of the way through, 3/4 of the way through Notre Dame, I met a turtle trader named Jerry Parker in Canadian Texas. So Jerry was there at a family get together, and so I got to meet. He was recently married to a cousin of a cousin of mine. So and so he and I got started visiting, and he explained what he did to me, and to me it sounded really exciting, just the idea of really using a set of rules to trade a market. And that's what he explained. And I said, wow, that's really interesting. And to me, what it was something that it fit my skill set. And as a math person, that I thought, if this is real, then this is something that I feel like I could do. And Jerry was kind enough just to say, well, and I think he was being nice to me because he had just met me and at a family get together. He said, well, if you ever want to come out to Richmond and I could tell you a little more, where we had a little more time to visit. Well, so about 3 days later, I'm calling him and said, hey, when can I come to Richmond? And I should have known he was just being nice. But when you're young and kind of dumb, you're like, well, I guess he really meant it. So I'm going to call him. But he did mean it, because I went out there to Richmond and spent a couple days, and we had a nice time. And he didn't tell me everything. I think he was aware that there was a lot of information he had in his head he couldn't tell, but he told me enough to really start me on my path. And I've always been very appreciative of Jerry taking time and being willing to visit with a young person just out of, we're not even out of college yet. And so Jerry he's at the top of my list of people I appreciate him, and I wouldn't be in the business without him. So it's fun to do this call, or this podcast, because I appreciate Jerry so much, and he's such a sharp person and a good person overall, and a nice guy to hang out with. But he was also very kind to me early on to get me started on this career. So that's the piece that probably people, they know, they talk about it some, but it really is. I wouldn't be here visiting with you all today without Jerry. So I appreciate Jerry. And I think it was Jerry's willingness to coach me. And then I think too, it helped my natural tendencies toward math and business, because those two natural abilities that I had, and particularly the math and the interest in math, and that's at the heart of being, I think, successful as a trend follower, to trust the math and not trust so many other things, the distractions around you that can get you off that. So I think it was a good combination, and I appreciate Jerry a lot.
It's funny because if you remember this, Salem, but as soon as I started Chesapeake, that sort of all of a sudden, this program was made available, came into the market, System Writer, now called TradeStation. And, you sort of helped me get that thing going because I didn't have maybe the math or the programming skills, but it was kind of not too difficult to get it going. But that was kind of our kind of thing that you really helped me with as well, getting where I could do something along those lines as far as back testing. And I think probably the first thing we came up with was that the old Turtle systems in some respects were probably suboptimal to the degree they were too short term, even for back in the 80s. But
we had fun with System Writer was a great starting out, and then that became TradeStation. You could tell the old timers because they call it System Writer, because it was, or TradeStation, I guess it was way back.
Yeah, one of my first employees absconded with my copy of System Writer. I'd like to get that back. It's probably worth having.
Maybe
worth something. Yeah.
One of the things that I've heard you that we've talked about, Jerry, the last few weeks, is this thing about you choosing to become more long-term pretty quickly after you started Chesapeake. And just one thing that kind of hit me the other day, and I was wondering, was this also a function of the fact that suddenly when you had more money to manage compared to maybe what Rich had given you to manage for him, that those time frames that you were using as an in-house turtle, so to speak, were becoming more difficult as AUM grew, or is that completely unrelated?
Well, I think changing the stop loss was just for backtest purposes. I remember inquiring about the choice of the initial size of the stop loss, and the response was, "Oh yeah, we kind of figured that was suboptimal. It was just our style." So we're like, "Oh, okay, we're going to try not to have a style and just let the research guide us." But as far as getting longer term, you see, that took many more years, the early 2000s. I mean, I would just, as I said on the podcast many times, I just like to peruse the charts. I think it's kind of dangerous to peruse the charts and make changes in parameter choices, but still I like to do it. And I put up a long-term weekly chart and then put up channel around it or moving averages, and I would just see, wow, we this trend lasted 2 years and we got knocked out 4 times. And so I'm like, yeah, maybe a longer term strategy would work. And I would take that to myself or my research people, and they say, yeah, you're right. Making those parameters less likely to get bounced out so quickly, it is a better approach. So it was really just experience. And then somehow we stumbled onto looking at it to where, in our opinion, the late 90s, the older parameters, the shorter term parameters, they really did stop working. I don't know if that means a great deal, because maybe they could always come back and work again. Trend following could get easier and the drawdown smaller. I don't know, kind of doubt it, but I guess that's one thing I'm not really sure of. I don't know what your thought is, Salem, but do you see that medium-term stuff, or maybe more specifically system parameters that haven't worked well in the past few years or longer? Do you see that as something that absolutely could come back to start working again? Or do you just try to make sure your systems have worked pretty well over the recent 5 or 10 years?
Yeah, I think that's a struggle we all have, and we try to figure out, well, where's the right spot to be on the time curve, because you see different trades, different times where the longer term things work, the shorter term things work. We've done, I think if anything, we might have split things. We've gone some that are kind of really, really long systems, but then we've done some that are shorter term systems that are even, for a couple weeks. And we found that I think they can all work at different times. And I think there's some wisdom in saying, let me have some of all of this. And, I'm going to have, hopefully there's going to be good scattered throughout it. And then you can overcome the bad trades. So sometimes I think it's fine to just spread out and have a little bit of all of it if you can do that. But if I had to pick, I would stay with just very long term, though. If I had to pick one, the longer term, because there is a cost, as we all know, and it's more significant than you think initially, that those transaction costs and the slippage costs, those are and those can be avoided with just going really long term. And so I think just reducing the transaction cost, that alone would say, hey, let me go really long term and just sit in this trade a long time.
Is this how you started out, Salem, when you started your firm? Was it long term from the beginning, or was it a mix of things?
It was more kind of probably a month holding period. So I was probably somewhere in the middle.
Right.
But then over time went longer.
Right.
And then have in the last 10 years added some of the shorter stuff back. And but we even do some mean reversion, some that I know is not as popular, but it hasn't done that well either. It's what's interesting, I think, about a lot of the things. One study we did recently, because so many things haven't worked well in the last 10 years, and I think that's a concern to all traders. And you see it across really the CTA space, that so many strategies have not worked well. So we did this study about 8 months ago, and we said, okay, and I went back to 1988. So over the last 31 years, and we had 40 commodities in that, 40 futures in it. They weren't all commodity futures, they were commodity and financial futures. But it wasn't a lot of, it was a good broad selection, because of things that go back to 1988. There's a lot of markets that don't go back that far. So everything went back to 88. Well, what we found was encouraging, I think, because you found periods when we said, okay, when did markets move, and how many what we call the fourth quartile movements. If you said, okay, where is the line between a third and quartile movement over a 60-day period? So we looked at basically a 3-month period, and we looked basically at the close to close, and we measured that, and we measured that in the terms of like a true range. Like we say, okay, how many true ranges have we moved in the last 3 months? Well, so then we look at that, and we count the number of true ranges, because we just step forward every day. So every year we'll have 250 look backs. So you're looking back at 3 months prior, the close 3 months prior, and you say, how many true ranges did we move? Well, then we say, okay, in 1 year, how many top quartile moves did we have? So it's basically saying, did the markets move? Well, then how many times did we have a significant move in the last year, and in the last 250 days? Well, so the punchline of it all was, when markets move, we make money. But if markets don't move, we don't make money. And so, I think the extreme logic would be, let's say crude oil stays at $58 a barrel and never moves off $58 a barrel, not a penny off for the year. There's no way to make money on that market, right? So then the inverse of that would be, well, okay, let's say a market moves a lot. Well, then we have to define a lot mathematically. So we tried to define a lot of movement. And what we found is, when there's a lot of movement, there's opportunity to make money, because those times corresponded to the years we made money. The last 10 years, there's not been a lot of movement. And then you say, well, when there has been a lot of movement, what happened? Well, like you look at 1988, there was this huge 50-year drought, or you look at 1990 when Iraq invades Kuwait. You have the energy markets double. You had a lot of other markets really move. You look at 2003 when there's a war. You look at 2008. You look at times when there's supply disruptions like what happened with grains. You see wars, which can cause supply disruptions, or you see financial calamity when you see people panicking in the markets. But basically, you see market movement. And so there hasn't been a lot of market movement the last 10 years. So it drove home to me the point of why have things not worked well in the last 10 years? And you say, well, they're just on average, there's not been as much market movement the last 10 years as there has been the prior 20. And it goes back to, you can put the best fishermen in the world on a pond with no fish, and they're not going to catch any fish. And so that's the kind of thing that's happened in the last 10 years. A lot of us that have worked really hard to try to figure things out, you hadn't been able to make money when there's no movement. And I think people say, well, trend following isn't working anymore, and these systems don't work. And I just think, give it time. Things will happen. I say, look, crap happens. Just give it time. And when it happens, you just want to be there and ready. And in the meantime, you want to protect your money and limit losses and be ready when the good times come. And unfortunately for us as traders, and the good times oftentimes are really bad times in the markets when people get emotional and markets move in an extreme way. So I think patience is what we all need.
I couldn't disagree with the word you're saying there, but what's also interesting to me is that, take a year like this year. If I look at the market so far this year, we've had, a 45% move in RBOB. Palladium is up 30%. Crude oil is up 30%. On the downside, you've had other things go down also quite significantly. But what surprised me was I looked at one of these databases of returns, and I tried to home in on just people I consider as pure trend. And there was one firm, and this is at the end of May, because obviously the June numbers are not out officially yet. At the end of May, one trend follower was down, I think, 19, and there were trend followers up 15% or so within the same 5 months. And that actually surprised me. To some extent, and I think from having been involved in this for almost 30 years, back in the day when you knew what Jerry's numbers were, you knew what John Henry was doing, you knew what Don was doing, etc. They were much more similar. That's how I remember it. I could be completely wrong here, but that's how I remember it. But now, I seem to see much more return dispersion. I don't know, is it just me noticing that? Or is there something more happening than, and is it too easy for us to say? I agree with you that the price range compression has been evident and it's there. But I also have to say that on our side, at least, we actually haven't performed worse in the last 5 or 6 years than we have done in the last 35 years on average. We obviously have bad years from time to time. So I find it difficult to pinpoint why people are saying that it is so much harder to do trend following today. And I think we give too much away to the press by always talking down our performance. I don't think it's that bad as such. It's not firing on all cylinders, but neither is value strategies and so on and so forth. And let's not forget, equities had their own troubles for a 10-year period or so. So anyways.
No, I think you're right, Niels. I think it, it hasn't been horrible the last 10. But I do think, thinking back, it used to be easier to say, hey, we're all making money and we're all losing money together. I think there's so many more markets now that I think there's things that people have branched off in, and then there's other strategies people have mixed in that you see the dispersion in the performance. I think, like this year, looking back, like the energy markets, they were in this big downtrend. And then they turned around. And so you never know when, so it depended on your time frame. if you were going to turn around and go, get long soon enough. That happened in grains too, where a lot of the grain markets were in a downtrend, and we got whipped. We got whipsawed there, where we had, the energy markets, the grains, we'd gotten short, and then they took off, and now we're long, and that's been. So it depends again on the time frame, I think, that you're looking at and your systems are focused on. And the last thing too is the equities. I think CTAs have gotten more into equities. I think Jerry does the single stock futures. We haven't done that. We've kind of gone the other extreme, where we haven't gotten into equities. We even limit our exposure to stock indices. And so, this year we're down on the year, down a little over 6% on the year. And but I think a lot of the people that have made money long equities, and so yeah. So, but we've always tried to just say, look, people have equities. We don't want to give them equities in what we're doing, but more and more over time, I think maybe that's a mistake. I think maybe we should go ahead and have some equities in there. But
well, I think that maybe when you don't have these trends, massive trends, that sort of magnifies the differences amongst the traders, and then not having a lot of overwhelming trends that dominate your performance. If we had a huge move, let's say like 2014, where we're short energy and all the CTAs were kicking ass, then all of these small differences, how you weight your markets, or what you don't include in your portfolio, or your parameters are a little bit different than mine. Those things are like beside the point, because we just all are making money short energy and long stocks or something like that. So I think that I think people try different things. And I think back in the day, maybe we're all really satisfied with more of what we consider a traditional trend following approach. Now, when we suffer, everything's on the table: short term, long term. Try this parameter, try this exit, and these things can maybe give off more of a difference than we'd see in better times. I don't know.
Yeah, no, I think you're right, Jerry, because if you have a market that just goes like a rocket straight up, at some point it doesn't matter if you're shorter term trend or longer term trend. Well, everybody ends up long together, and everybody makes money together. So yeah, no, when you have markets that aren't on a one-way trip to the moon or a one-way trip to the dirt, you don't have that correlation in systems as much.
Well, it's all about the time frame, like you say, Salem. Remember speaking about last year's performance, 2018, and I think we agreed that the shorter term systems were doing better, right, Niels? We were looking at some performance numbers from other sources, and the shorter term systems were the best performing systems in 2018, probably on the back of the equity corrections being relatively quick, more abrupt. There's never been a 3-4 month trend that never established really on the downside. And so if you traded a longer term system, that wouldn't have been the right approach just for that time period, right? Who knows what next year will bring, or what the second half of this year will bring. We don't know that. But all of this, to me, means we just have to trade all of those markets and diversify as much as we can, not just across the markets, but also across the time frames, the entries and the exits. And I think this is all we do. We all do the same thing, maybe different time frames, different ways of getting in and out of markets. But definitely, as far as I'm concerned, there's a mix of things in there. Overweight to the longer term side of things. But I haven't completely given up on the mid to short term systems.
I think people have differences of opinion. I think over time, people are more willing to not agree and do different things, and overweight and underweight. And so I'm pretty happy. I made 30% in December 1990 in heating oil, and I made 30% for the year. So I am so far from that idea. I would like to not make I mean, you listed all those markets, Niels, that were sort of had trends or whatever. Palladium was one of my favorites, of course, and emissions. And I feel like I have an approach that it's almost impossible for a handful of markets to move the needle very much if it's going to be these trends in half a dozen markets. I need like lots of markets to move me because I'm so broadly diversified. And likewise, small sell-offs or large sell-offs in a handful of markets is not going to crush me.
Mentioned half an hour ago that I lost 1.5% or something like that for the week, right? So even a performance like that, as strong as the one that Bitcoin delivered in the past week, that hasn't been enough to really move the needle really for my portfolio because, it's a properly sized thing is incredibly volatile. So the position size is small. But I always think about these things as, like you said, Salem, we don't know about any of those currencies and what their value is because really I don't think there is any value. It's the value that people give the thing that they trade, right? And it could be outlawed. There could be, some law saying, Bitcoin is no longer allowed and maybe the thing drops to zero. Maybe it goes to 1 million. Maybe it goes to 2 million, right? But when I look at that from the outside as an observer, I always think, and I've been on the record here with my friends saying that I think it's a greater risk to not being exposed to Bitcoin than to be exposed to Bitcoin. I think it's one of those things where you have to put your toe in the water, properly sized, and just go with it and see what happens.
Yeah, more it's the things that are interesting that you're saying that I think your listeners need to really soak in too is how people would think, well, Bitcoin, it's a crazy market. It's really volatile versus say something, that's not as volatile. But what's interesting is as traders, and I think the CTA community is better at understanding it because you trade so many different markets of different volatility that you have to learn, okay, let's size them right. And in the end, they are all the same once you size them right. So it's not a big deal. Here's a really volatile market. It isn't going to swing your performance any more than a really, low volatile market. So I think that's, sizing positions right is always important. Where this exciting market like Bitcoin, you think, well, yeah, it's really exciting, but it's a really small position because it is so exciting. We try to make it boring. We could try to get the volatility where it fits. So there's that. And then being broadly diversified. This year we've added, in the last really 2.5 years, we've added about 20 markets. And some were really, some thinner markets that we're able to trade because we aren't, a billion plus firm, and we can trade and have some meaningful exposure in some markets. And when you have these, like iron ore, was been our best market for the year. And it was funny because iron ore has gone up maybe double, not quite double. And none of us know iron ore. We just don't know the market. And so it was funny. We were talking in the trade room a couple weeks ago. They're like, well, now why is iron ore even going up? And we're making money in this market and we don't know why it's going up. But what we do know is that it's gotten at a level that it's not been before. And we know when that happens, people get emotional. And if they get emotional, they get somewhat predictable. And you see this, you're really trading off this human component that people are going to fight the price movement. There will be people that sell at what they perceive at a high price. And we're going to be the buyers. They're ready to take that off their hand because we know a high price can be an extremely high price. So I think the idea of sizing positions right that you mentioned, Moritz, is interesting. And then just being broadly diversified. That's where this needs to be a self-help session for me to get me to make the leap into trading Bitcoin. So y'all need to, and I see the reasons. I know the reasons you're going to tell me, and I'm going to say, yeah, I know I need to do that. I need to at least dip my toe in the water because I've been reluctant to do so. But it is, it's a market that, regardless of what I think about it, if I don't understand it or don't, but it's no different than iron ore in a way.
We don't understand. We
Exactly.
need to admit that we don't understand anything, and neither do the rest of y'all. It's you
Exactly.
don't understand this. You may think you understand it. Oh, I had this idea in my head. I was listening to the news. I bought something. It went up. I understand that. No, you don't. You don't understand it, and that's just fine. I mean, what's the craziest market prior to Bitcoin recently? Probably corn.
Yeah.
And if you don't, you got to size corn properly. I remember had one client who didn't make money in 1994. Yeah, I made 15% in 1994. It was all coffee. And one of my clients called me up and said, why did I break even for 94 and all your other clients made 15%? I said, because you told me not to trade commodities. Well, we thought commodities were too volatile. I'm like, yeah, but you got to size them properly based upon their vol. Oh, okay. You can start trading commodities now. So I think that same thing is going to happen with all these markets in Bitcoin. Is it liquid? Yes. Is it halfway decent as far as correlation with other markets? Oh, God, yeah. Okay. It's a trade. Put it on. I think it's a political thing, possibly. If you tell your big institutional clients that you have a lot of Bitcoin on, that may not go over well. But as far as doing the right thing for yourself or your fund, I think it's, the next Bitcoin that I don't understand, or the next stock that I, Beyond Meat. As soon as I get 250 days, I'm going to start trading Beyond Meat.
Oh, that's painful to a Texas boy out on ranch land, isn't it? It's like, oh, yeah. But okay. Yeah, no, I don't understand it, but I need to trade it, right?
That's right.
So
whether you like it or not.
That's it. Well, you mentioned the corn trade. Corn is an interesting market now because of, there's a lot in the USDA reports there's a lot of really kind of bad information mixed in there. And, that it's gotten to be where at the moment, corn is hard to understand because of insurance, these prevent plant insurance things that happen. And it's hard to predict what a corn farmer is going to do when you start paying them maybe more money not to plant their corn than to plant their corn. And so, so there's all these crazy things that come into markets that I think anyone who's looking at the fundamentals, they can't say they understand it. And I think you read a lot of Twitter posts on corn lately, and there's a lot of smart people in the corn market that say, this doesn't make sense. I don't understand it. And usually they don't admit it, though. They say, oh, no, I understand it, even though they don't. So,
part of the podcast is me going over my tweets. And you're probably not interested in Twitter too much, but I had a lot of good tweets this week. One of them was about, understanding the markets and, do we really understand them, and do we really know what to expect? And one of the tweets was a very famous person saying, hedge fund people are my favorite people. They will change their mind in an instant. If you present them with contrary information, they'll just suck it up. They're very interested. And if you're right, they'll get out of the short and they'll go long. And I think that this is another thing that trend following does as well. We just cannot have this emotional attachment to my long corn or my short. I thought I was hedged this week with long corn and short beans, and they all reversed on Friday. So, but anytime you're in a situation, especially we have an edge because it's systematic, and we're not listening to advice or arguments as much as our rules that have been back tested and have done us right in the past. But a great quality for us is just to reverse that position as long as the system is demanding it. And we're the most flexible possible. Nothing, the trade is not my little friend. I'm not emotionally invested.
Oh, what's funny, Jerry, about what you're saying is, I think when we've talked, I know you hear it in trend following circles. Sometimes these trades that are painful to put on are sometimes the best, but actually when you know nothing about a market, like for us, iron ore, we didn't know how dumb it was to be, long at these levels and as it goes up and up. But sometimes my crew on the trade desk, there's a lot of cattle people. And I remember the cattle trade back in 2003 when cattle prices, they got to a level, it gotten to the low 70-cent level. And all of us know the cattle market. And so we go long, but this is a level we haven't seen in 3 or 4 years. And so everybody in the trade room was like, kind of roll their eyes and look at that, and they're like, man, this is a dumb system. What's it doing going long at these levels? Well, then after about 6 weeks, it got in the mid 80s. And so I'm in my office, and Shane from the trade room, one of the guys in the trade room, comes back and he says, hey, cattle are up limit today. And I said, oh, that's great. And I said, so where's that put it? Oh, it's at 85, something. And I said, well, that's great. And so I kind of looked back down. He said, no. He said, you don't understand. He said, we've talked about this. This is nuts. You need to take some profits here. Said, I know the system is a system, but we've all been talking. I said, so wait, so you got sent back? Like, you're the guy that got sent back to tell me this? Yeah, no, I'm the guy that we've all talked about it. I said, so I go in the trade room and I said, okay, tell me why this is crazy. And they said, Salem, this was crazy when we bought this at 72. We hadn't seen these in 3 to 5 years, and now it's rallied up to 85. We got at least half the price. Take something off the table. And so I told them, I said, you know what? I said, that's why trend following works. I said, and so we went through this. I said, well, of all the ranchers in the area, how many do you think have sold their cattle? They've contracted their saddle, pre-sold their cattle. And we all guessed, and we were basically all guessing 8 or 9 out of 10. And I said, okay, now let's call the steakhouse downstairs. So we have this big steakhouse on the first floor of our office, and people come from 100 miles around to eat the steak. So we call, and the manager answers, Brad does. And I said, hey, Brad, it's the guys upstairs, it's Salem and us. And I said, we're wondering how much, because before we called him, I said, I bet they're light on inventory. And let's find out. But my bet was light. So Brad said, yeah. I said, what's up? And I said, well, we're wondering about the cattle market and wondering about steak prices and all. And he didn't even let me finish the sentence. He said, have you seen these prices? These prices are nuts, the meat market. And I said, well, so what's your inventory then, Brad? Do you have a lot of inventory, or average, or less than average? He said, oh, we've got the least we can carry just to get us through. And I said, okay, that's what I'm wondering. Thanks. And so we hang up the phone. So I said, okay, so the steakhouse, they've got the least they can handle. So they have to buy steaks next week. They don't have a choice to keep open. And you've got 8 or 9 out of 10 of the cattle guys have sold. I said, that's what makes a trend following, a big trend move possible, because this market could explode because you've run out of cattle. Everybody's sold. And the people that are buying, the psychology works on both sides of the coin to make it possible for an extreme move to happen. And so cattle ended up, I told him, I said, I love the trade now. I said, I love it more than I did before. Now I understand it better. But when we don't understand a market, we don't question those trades. It's funny how we question a trade that we think we know something in. But the clue of feeling really stupid, that should be a positive. I mean, that's something that tells you you're on the right side of the trade. And if you don't have a lot of company, if everybody's telling you you're stupid, that's a good sign too. So
I think what you explained, Salem, is something that I think we've all come across, right? And you've been doing this for a very long time, and so I'm just curious. I mean, how do you bridge that gap, really? Because what you describe here in terms of even your own internal traders saying, we should get out. This is, let's not follow the rules 100%, and all of that. They're just expressing, I think, what 99.9% of investors are feeling and how they probably act when it comes to investing. So what have you found works in trying to explain and convince people that what you do and following rules and not, getting emotional about these things, that is something that is worth having in a broader portfolio?
Niels, I think the only way is just the best way is to show them some good performance over time and that it's been successful over time. Because it's not something that people really gravitate to. For me, it's easier because I think for people that really trust math and they see math and they see statistics, that make sense, it's easy to trust it. But it's difficult when you can't explain it.
Can you visualize math, so to speak? I mean, since you understand it, you trust it. How can we help investors who may not understand nitty-gritty math like you do, but I mean, is it possible to visualize in some way that we haven't maybe done well as an industry? But I mean, because it seems like it's the same issues, it's the same discussions that we had 25 years ago that we're having today. It's the same conversations, and now I would even argue that maybe it's becoming even a little bit harder to some extent because of two things that I've come across at least. One, it's this label that we've become, crisis alpha, because I don't really think that it's that fitting as such, and it's certainly not helpful. I mean, it's sure we make money from time to time when there is a crisis, but we don't have to have a crisis to make money. So that's one thing I think makes it harder.
And sometimes we have a crisis, we don't make money because the crisis now is defined as a few weeks or a few months.
Or a few hours or a couple of days or whatever. I mean, that's one thing. But the other thing I've seen recently, I actually saw it this week, and I wrote my longest tweet ever, which was one of those things that I learned from Jerry, where you can add multiple tweets to the same thread, which is fantastic.
Oh no, Jerry's a bad influence on you, Niels.
He's a great, yeah, absolutely. I mean,
thanks for that, Niels.
So that's fine. But what I saw this week was a couple of analyses and also from a podcast I'm listening to, and I have the greatest respect from the people who are doing this, but they all conclude from their deep analysis, but trend following doesn't work on equities, right? And so they make all these studies, and it comes out as, equities compared to long only or whatever, it didn't really work. But my point is, and this is what I was trying to express in all these tweets, trend following to me was never intended to just work on equities. I mean, it may or it may not do, but equity markets as futures were not even invented when the pioneers of trend following started trading in the 70s, right? So the part of the secret to why it works is the diversification that is built into these portfolios, et cetera, et cetera. And frankly, the discussion the point that Jerry just made about someone in 1994 didn't want to trade commodities, I came across that this year, where one of my clients basically said, well, we have some conversations with our underlying investors, and they prefer a trend follower who doesn't trade commodities. And I'm thinking, and they actually said, because commodities are more risky, right? And I'm thinking, no. I mean, how did you get to that conclusion? And it's not to pick on them, because I know there's a lot of pressure from underlying investors. I actually think the clients we were dealing with are great guys. But it just shows you that some of these same issues that we've seen 20 years ago and so on and so forth, they still pop up. So we need to become better. Frankly, it's a challenge to us. We need to become better at explaining why it works. Not maybe using too fancy terms and math and all sorts of skews and no skews and whatever. We just need to be able to explain why it works and why people should be comfortable with it and why it should be part of a broader diversified portfolio, even though sometimes Jerry and I gets into discussion about whether it should be all trend, but let's just keep it civil today when you're here, Salem, and then we'll say that it should just be part of a portfolio. I'm sure Jerry will agree with that.
No, just today, one story that's a funny one that helps describe some of what we're talking about, because what we're really modeling is human behavior, and I think we're all wired as humans in a similar way. If you think about our ancestors, the ancestors that were the brave ones that went to take on the tiger, they might have gotten eaten and didn't have offspring, but our ancestors were maybe the safe ones that stayed in the cave or something. And so, there's a lot of things that are wired into humans that is common across all of us. And I think that's what we're modeling is human behavior. But we're seeing it show up as you measure it with math. And so one of the things, a funny story, because I think of sometimes a market is like, 100 people in a boat. And I think of the boat, if they all go to one side or the other. And so I've always had that in my mind for at least 20 years. And so it was funny that I heard on the radio about 10 years ago, they were talking about a bunch of tourists down at Lake Austin. And so they were going around the lake and showing them the sights. And so they go by and they say, now on the right up here is Hippie Hollow. And Hippie Hollow is a nude beach. And so now if you're on a tourist boat and the nude beach is on the right, which side of the boat do you figure most people are going to go? And it's just human nature. Everybody's like, okay, so everyone is on the right side of the boat. Well, then what was so funny about it is there were so many people on the right side of the boat that the right side of the boat capsizes. So the gawkers looking at the nude people on the beach, they're now in the water. And who is it that's going to rescue them? But it's the nude people on the beach that swim out to help them get ashore. And unfortunately, people on a nude beach are not like we would imagine and say, well, they're all supermodels. They're generally unattractive, naked people. So now you've been coming along and you're gawking at the unattractive naked people, but now they're the people dragging you ashore. And so it ends badly. So you've always got to be careful, with your human behavior, because your human behavior may lead you all to being rescued by unattractive naked people, and that's not what we want to happen. So as trend followers, we're playing off human nature, and they're predictable. So yeah.
And we're playing off human nature, and because it's where the systems replicate things that are hard for humans to do: buy the high, sell the low, take small losses, diversify, live through lumpy performance. And then that's why we make money. So we shouldn't be surprised that they don't like that. They don't like it when we do it. They don't like it when they do it. They can't do it. And so I think to some degree, I've never been a fan of another thing we kind of don't really agree on that much, is that I've never been a fan of this education thing. If Rich would have come to us after 6 months of trading, and I would have bellyached about not making money and I wasn't following the rules, he wouldn't have said, "Oh, I just need to educate you better." No, the right thing to do. People know the right thing to do. They know about diversification. They've read about it, but they're human beings and they're going to have a hard time doing it. I look at my portfolio and I just wonder, how many times do clients of CTAs see the entire portfolio? When I look at my portfolio and I see corn and wheat and Swiss franc and other commodities and stocks and IBM and Microsoft, I just get a big smile on my face. It just makes me feel so warm. Now, maybe that's just me, and I've been doing it for so long, but I really need the security of that diversification. And I've got longs and shorts. Then how often do clients see that? How often have they seen a chart or lived through a situation where some of these crazy markets have made a lot of money, short energy, 2014, and seeing that chart and seeing sort of how it went down and how it wasn't unusual to make money in that. And I just don't know if people are fully living with it on a daily basis just by simply seeing the charts and seeing the portfolio like we are. But once again, I think it's a premise of life. It's the road less traveled. It is a narrow road. And I think to some degree, we'd be better off if we approach people by saying, look, here's what we do. You probably can't do it. You're probably not tough enough. You're definitely smart enough, but it's probably not for you because this is just too hard mentally, and challenge people. But I think finding the right words that tickles their ears, that, oh, when you put it like that, that's just never going to happen. When I was 26 years old working for the accounting firm, I stumbled onto some book or some article about trend following. And I fell in love, and the love has just gotten deeper all since then. And I had no one telling me exactly how to do it. I thought to myself, wow, the key here is the big win's going to pay for the small losses. And then I sat there with my calculator, and I put into my calculator compounding 100% a year. And I was like, yeah, this is going to be a really fun thing. I love this.
No, well, that's the math. That's where the math gets you comfortable. And as an accountant, you knew, no, this will all work out. Well, the diversification, what you talk about there, and chasing performance, which we've all seen. If you're properly diversified, you're going to have things that do poorly in a given year and things that do well. If everything does well in the same year, you weren't properly diversified probably. And so, and there's always going to be something, the worst performer in your portfolio. But what you find is a lot of people they throw out that worst performer. They say, well, this hasn't done well. And so we don't, the last 10 years in this, so we need to go to something else. And I see it on investment committees, and there's a lot of smart people that, it's not like these amateur investors are really smart people that they say, look, no, and they come up with a reason that it isn't really chasing performance. They have a very colorful way to describe it that's, and reasons that sound real logical. But it's, in the end of the day, you're chasing performance. And so what I tell people, I said, look, if you haven't ever had a flat tire in 10 years, you don't take the spare tire out of your car and say, hey, there's no need for this anymore. You leave it in there because there's need for things in your portfolio that sometimes aren't going to do well, but they're there for a reason. And so people need to remember why they were there in the first place.
I mean, I think you bring up a good point, Jerry, as well. And in terms of, how much do we tell people? I mean, probably the less they know about what we do probably would be better for them. On the other hand, we all want to be transparent, and transparency has become a really part of not just our industry, but the whole financial industry. And so when we do provide this transparency, and unlike you who see all of these markets and you smile, I mean, my experiences are often that what people see is just, oh, but you're long equities. I'm already long equities, so I don't really like that. So it's really hard to find that balance. And of course, a lot of people who write about. I think there was a study out, or there's some kind of analysis or study out where Fidelity had looked at the best performing clients they had, the best performing portfolios they had, and it turned out that the best performing portfolios were the accounts that people had forgotten they had, where they basically had made no changes to them for like 25 years, and they were the best performing portfolios or accounts. So it goes to tell you, I mean, how hard it is for people just to leave things in order and just to trust the system, trust the process, et cetera, et cetera. I mean, and that obviously comes back to human behavior. A lot of the things that has made us, a lot of the things that we do in terms of humans, like being, super confident, can get you a long way in life, but it can get you in a hell of a lot of trouble when it comes to investing. So there's a lot of these things that are completely counterintuitive to how life plays out to when it comes to investing. And I think that's part of the challenge.
I agree. I do think, though, that a little bit of education might be needed as it relates to trend following stocks and not trend following stocks. So I think that could be quite a bit of difference. I think that if it's okay if you want a lot of stocks or mostly stocks, but wrapping trend following around it could usually create a much different performance, sometimes better, sometimes worse than buy and hold. I mean, unfortunately, the best example has been recently where the stocks kind of crash and we all liquidate, go short, and then they turn around. We have to get out of the shorts and get back to being long, where this person who doesn't check their statement, that's why they've done so well. They have, they didn't do anything, and the index holders, passive indexers, they didn't do anything. So pairing, I would say that if you just looked at the numbers and stuff, and I guess, it depends upon how many decades you go back. If you go back long enough and look at all the data, lots of data, probably diversified trend following deserves about 80% of the portfolio, but a 20% long S&P position probably helps out a little, helps out quite a bit, because that is the antidote to whipsaws, never getting out.
think we should go back to having only quarterly or annual NAVs and then only show statements to clients once a year, and then we're getting an even higher performance fee for that. Just kidding. But one thing that I wanted to ask you, Salem, with us mentioning that we're playing off the human factor here, which I agree with, is what do you think about the fact that there's less humans participating in the markets, and it's more computers and it's more systems, not only trend following systems, but all sorts of, trading systems, be that mean reversions, stat arb, you name it, high frequency.
At one point way back in, let me say 98, 99, I did high frequency trading in my shop for about 6 years. It was from only my own account. It was back in the 90s when everyone got really frustrated with the managed future space, and a lot of them left. And so we kind of had to find something to do. And it was when the CME was going electronic and opening up Globex. And so we did for about 6 years, we did what we called electronic trading. Now they call it high frequency trading. But what so much of the high frequency trading, everything we did was arbitrage. And so we were taking liquidity from, say, the ETFs, the stock index futures in the ETFs from stock index futures over to the ETF market, the SPYs and all that. And so I think a lot of the electronic trading, and I don't know how much, it would be interesting to know, but the biggest part of it, I think, has to do with arbitrage. When you're trading, ETFs that are a basket of stocks, you can do the basket of stocks versus ETFs. A lot of ETFs are based on things, even, the price of crude oil or the price of different commodities. So there would be arbs there. So I don't know, so to the extent that there's arbitrage, all that is making the markets more efficient and tighter bid offer spreads, really. So I think a lot of the electronic trading, I really think it's very positive for the markets because of the speed you can tighten up markets, and because of transferring liquidity from one liquidity pool to another, I think that's good too. So I
agree with that. I mean, this is making the markets and reducing spreads, and they're looking to make the spread, and probably that's good for us. I think I was more about there's all these smart beta people, the risk factors, the risk premia, more of that stuff being launched and attracting assets, more people going passive. ETFs are on the rise, all of that, and we were thinking on that podcast and discussing, to the extent that we could, what the impact could be there, and whether that may have an impact on trends and the way that our systems work. And what's your view on this? Do you think that's too much, or is it doesn't matter?
I don't know. It's got to matter. Anybody buying and selling in the market has to matter. So, but I don't know how much it. I don't know how much. I think it's a great question that I don't really think any of us have a good answer to it. But I just know from my experience with electronic trading, with so much of it being arbitrage related, I felt like that was a positive. I think having markets being electronic and really not having floor traders, as much as I know we have all had friends that are floor traders, and but I think the electronic markets are more efficient. I think there's lower costs. So, but the one system trader, we're certainly system traders. I don't think we have not seen more slippage. I know. So we don't see the trend following space more crowded. We don't see, if anything, we see it easier to get trades off. And so we don't see it really interrupting what we're doing. And I think at the end of the day, it's kind of small noise in a bigger, if you have a, let's say a financial calamity like in 2008, or if you have a war like in 2003, or a drought like in 88, I think the big moves will still be there to capture. And I think when they come along, there'll be opportunities. And I think the noise in the middle and how people trade, I don't know that will matter as much. because so much of it is kind of market making, and you could see market making programs and things like that. And so there's a lot of ways to extract money out of the markets or make money or participate in the markets. But I think at the end of the day, the big moves that we're trying to capture are still going to be there. But I could be wrong. So I don't know the answer for sure, but I don't. But I think I do come from a place where, having done high frequency trading for 7 years, at least I've seen it, and it doesn't scare me that people are out there doing what we did for a long time. So, and we quit doing it because it got so efficient.
Right.
So, which is a good thing.
I mean, I don't have the answer. It's, one of those things that, you think about, but it's kind of like impossible to find an answer, even, get to the answer of that. But, I was always, bringing it up because we've heard, larger firms, Winton, reducing exposure to trend following because they think it's, crowded or it's too much. And kind of like, us guys, we hang in there against all those headwinds. You just carry on. Like you say, waiting for the next big move. At some point, some big move will come. We don't know what market that's going to be, but, and we don't know when it's going to be, but I don't want to throw in the towel. But, every time you read about those things that, certain types of behavior in the market may have an impact on the way that we trade. Obviously, we want to understand it as much as we can, even though in that case, it's impossible to really get to the bottom of the thing here.
No, but Moritz, I think I think you're spot on with, when you see smart firms like Winton, and we all know David Harding, and he's been successful and is a smart guy. And I remember Stanley Druckenmiller, there was an interview not long. It was right around that time that Stanley was saying he felt like it was harder in the markets. But again, that's where the study, that was kind of the reason we did this study, looking back and saying, okay, well, why has it been more difficult the last 10 years versus the prior 20 for my trading career? And has it been, is there a reason that we need to maybe say, hey, we need to stop doing this. This isn't working, and it won't work in the future. And I as much respect as I have for those people, I think they're wrong with it, because I think why we haven't had the opportunities is we haven't had the market movement. And when the market movement comes, we'll have those opportunities. And so, but it isn't electronic trading messing it up. And again, I mean, those people haven't done electronic trading. I have, but I haven't done every type of electronic trading. But we made a lot of money trading electronically for the years we did it. And then what we saw, the space got crowded and the money got thinner, and it's an expensive operation to run, because you have so much computing power and, lines connecting you different places, and there's a lot of cost with that. But at the end of the day, that makes the market more efficient. And so I'm not at all afraid of the electronic traders out there. I think if anything, they help us. They provide liquidity. I don't feel like I'm getting gamed. We don't see the evidence of getting gamed. I think if if you're getting gamed at some point, you will recognize it. I think in the markets, we track slippage on all of our trades. We have for goodness 20 years at least. And
how about the number of whipsaws, Salem? Do you see that increasing, to the percentage of winning trades being lower?
Well, I think you do, just because I think the trends that start off don't continue. You don't have the big moves. But I don't think it's people. Do you think it's people doing it to us, Barry?
I don't know. Jerry? I mean, I just think that that's just not discussed enough. I think it's almost a silent killer. You wouldn't even know they're inside. And I think what needs to be discussed along with we need more trends. We'll get these trends. Trends always were there, which all of that is makes sense. I get that. But a little deeper, okay, we don't even realize they're nicking us a little bit on the entries. They're getting us long, where they ran wheat up there on Friday, and then it's down Thursday. Then it's down 20 cents on Friday. So I'm just saying things like that that get us a little bit on the exit. We're not making quite as much as we used to. And then we're sitting here going, well, it's all about these big trends. And we still see big trends. Oh, they're much smarter than that. And it would be almost imperceptible to some degree. When you first got into this, I was thinking like, it reminded me of this quote I had on my Twitter page, which was hedge funds should be like small restaurants. Loyal group of clients, unknown. And I think maybe this systematic trend or systematic trading in general, or some styles of trading that really you don't have a lot of people interested in them, and their ease and clients are looking forward to redeeming quickly because their heart is really not in it. I think maybe if the industry is made up with, it needs to be made up with a lot of small firms who are just totally dedicated to staying with it. And maybe then maybe we become, if we had hundreds and hundreds of $250 million firms or $500 million AUM firms, then maybe these people would leave us alone. And maybe that would help us a little bit, that it's not worth their trouble. But it's hard to imagine with billions and billions of dollars of trend following money being spread around that based on breakouts that, oh, we're being ignored by the smartest people on the planet who trade short term. I don't know. That doesn't sound like if we are being ignored, great, but we probably should think about it and worry about it more.
Yeah, you don't want to be the guy being gamed. That's for sure.
What's that blackjack? No, that poker statement.
Yeah.
If you don't know who the patsy is at the table, you're probably the patsy or something like that.
No, that's it. We don't want to be that person.
But I think your conversation brings up a couple of really interesting points. One is, I mean, you say, Jerry, that maybe it would be better we had $250 million firms. I mean, maybe we just have to also accept that perhaps trend following doesn't work so well when you manage 10 billion or 20 billion, and that's why some of these bigger firms decide to scale it down. I mean, I wouldn't be surprised if that's the case. I've often made that argument because you lose a lot of the diversification. You can't trade the smaller markets, so you lose that automatically. And I think still part of the success of trend following has to go hand in hand with the importance of diversification. So that's one point. The other thing is you talked about why maybe this doesn't, why we shouldn't be so afraid that things are being I'm losing my train of thought here a little bit. But the point I'm trying to make is that the reason why trend following will probably never be overcrowded is because it's hard to do. It's not because we have the source we all use is not that different and it's not that special. What makes it special is the fact that we do it and we implement it and we sit through the drawdowns, which most people don't want to. So I don't think that...
But you understand the other point I'm making, which is the computers know that if we could just get it up to the 200-day high, we'll see some buying. And then once we get them long, if we can just get it 4 or 5 ATRs below there, then we can get them liquidating. You understand this gaming, and this is what I'm talking about.
Yeah, and I agree with that because that's actually one thing that Stanley Druckenmiller did bring up in one of his interviews. He did say that he felt that there were algos today out there trying to revert markets to the mean. As soon as the trends were getting established, he felt that there was something pulling them back that he had noticed. And I think that's probably true, that there probably are some people out there who have developed algos to do exactly that. That's their strategy, and that's perfectly fine. I think we also know that if they at some point become unsuccessful in that, meaning if the trends are so strong that all of these mean reverting strategies basically have to capitulate at some point, that's going to reinforce the trends eventually. But I agree, it could be why it's been a bit more difficult in the last few years, that there are more and more people betting against some of these trades that we do.
And that's all I'm saying is that it makes me nervous. I'm not even saying that I agree or disagree. I don't know. All I'm saying is talk about it. If you're going to bring up big trends, human nature will always have trends. Look at that trend, blah, blah, blah. Also just say that's not the entire argument. it's another argument. We make a little bit less on the entry. We have a few more whipsaws. We make materially less when the market sells off. We have to liquidate. We've had some violent crashes, blah, blah, blah. And then when you total it up, you're like, how in the world did we get more trends in 2020, let's say? We got some of the most amazing trends ever in 2020, but we didn't make nearly what we would have made with 2/3 of those trends historically. Now we're getting somewhere. It's very complicated. It's not, there's trends, there will always be trends. That is not, you're not even getting close to the truth. Not you personally, I'm just saying. I read that a lot. I read that a lot. Oh, there's trends and there will always be trends. So trend following will always work. Oops. No, not necessarily.
Jerry, don't you and Niels and Moritz, don't y'all think that back when the floor traders were on the floor, we got played by the floor traders some, though?
Exactly. I mean, this is something that has been in my brain since December 1983. What's funny is, little known fact, I have never read the Turtle books. Apologies to all the authors out there. I'm just afraid to read the books. I'm afraid of what's in those books. I don't want to read them. So, but I don't know if this is in the books, but let's say that the System 1 in 1983 was 2 weeks higher, 1 week lower. Well, so you bought the 20-day high and you liquidated at the 10-day low, but that was not the system. No. One huge part of that system has always been left out. It was not exit at the 10-day low. It was anticipate the stops at the 10-day low. So if the chart pattern stood out the 10-day low and you thought there could be stops below that 10-day low, anticipate that, get out before, and so the whole system was built upon this idea. What are other people doing? Where are their stops? Where are your stops? Don't let people find your stops. And so that's kind of been lost over the years, but it's never been more important. They're out there gunning for our trades. They're smart people. What else are they going to do? How do they set it off? Renaissance is making 50% a year with 50% incentive fee, but they're not targeting CTAs. Come on. Really? That's your attitude?
And now all
you're
the
a risk
turtle
manager.
books and now all the turtle books have to be rewritten because that was a nice little scoop that we got there from Jerry. Any closing thoughts, themes that we want to bring up before we slowly start to bring this conversation to a close? Any key takeaways you want to bring up, Salem, that you have come across, you find particularly interesting at the moment?
Well, yeah, as a kind of put a bow on it, it's interesting. We've talked about. It reminds me that Sun Tzu, Art of War, know thyself and know thy enemy, and you shall have 1,000 victories. And I think that's the challenge: is we have to know ourselves and how our human tendencies lead us in the wrong direction. And I think that's important. And then know what other people, like what Jerry was saying, are there people out there gaming us, and how do we, there's the opportunities we have in the marketplace, but there's pitfalls. And I think we need to know all those because the enemies are various and wide and numbered. So yeah, it's interesting. I think of that.
I would say first step is to admit that you might have some.
Right.
Yeah.
Mm-hmm. Oh, we surely have them. I'm pretty sure we have them. I mean, we've said that even a 200-day moving average system is probably a better system, or preferable to just being buy and hold long only. But if I just reflect on myself, would I be trading a 200-day moving average system if I had other choices and options? No, I probably would not, just because of the fact that I'm concerned that this system is so much in use out there and, spotted so easily. The levels are spotted by everyone, by machines. I don't want to be exposed to that exact point, right? Different points in, different shapes and forms, maybe different ways around that same time frame, but not exactly that point. That's not where I want to go. But maybe this is already also known fact.
That's right. They already know that.
Exactly right. And then the third element of the fourth element of that is never-ending story. But I agree with that. We have to, when you develop systems and do your research, this is what you also have to think about and concern yourself with.
Big Brother is watching, even our stops nowadays.
Yes.
Well, it's a real pleasure for me to be here with you all. It's always fun to visit with smart traders and smart guys like y'all, and it's especially fun to be here with Jerry because I think so highly of him and appreciate all again that he's done for me over the years. And we've had a lot of fun conversations and interesting conversations, and I always enjoy that. So to add Moritz, you and Niels to the picture, it's fun. So thanks for having me on. It's great to be here. Be here today.
Hang around a little bit longer, Salem. We're just going to go through a couple of things that we normally round off with. So we're going to run through the performance as it finished. This is always as of Thursday evening, which wasn't quite the month end this time around, but it's going to be close. Maybe Friday was a slight positive day, I would imagine. But anyways, the Beta 50 index up 1.82 for the month of June, up 5.05 for the year. SocGen CTA index up 2.26 for the month, up 4.53 for the year. The SocGen trend index, probably closest to our hearts, up 2.57 for the month, up 7.25 for the year. The short-term traders index made a good comeback this month, up 1.89 and now slightly positive for the year, up 0.05. And the bridge alternatives up 1.32%, up 5.18 for the year. And of course, as usual, you can send all your questions to us at info@toptradersunplugged.com. Any last thoughts, Jerry, Moritz, Salem, before we wrap up?
No, it's been great fun.
Yeah, a lot of fun.
A lot of fun. Thanks for having me, guys.
Yep.
Salem, thank you so much for spending your Sunday morning with us. We really appreciate it, as I'm sure all our listeners do. And just one big favor to ask all of you listening. If you have 2 minutes, don't know what to use them for, then please do leave us a 5-star rating and review if you feel we deserve it. It makes a huge difference to the show on iTunes in terms of the podcast rankings. I saw there were some really nice ones coming in this week, and they do help. From Salem, Jerry, Moritz, and me, thank you so much for listening, and we look forward to being back with you next week.
Thanks for listening to the Systematic Investor podcast series. If you enjoy this series, go on over to iTunes and leave an honest rating and review. And be sure to listen to all the other episodes from Top Traders Unplugged. If you have questions about systematic investing, send us an email with the word question in the subject line to info@toptradersunplugged.com, and we'll try to get it on the show. And remember, all the discussion that we have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their products before you make investment decisions. Thanks for spending some of your valuable time with us, and we'll see you on the next episode of The Systematic Investor.